We've got a massive financial deep dive today, and the story we are tackling is one of a fundamental paradox. We are looking at a bank that is experiencing this aggressive, rapid expansion, pushing its balance sheet past some crucial milestones, while at the same time executing this really strategic, conscious shift away from risk.
That's absolutely right. It's a fascinating balancing act. We've unpacked the source material, so that's the Q2 and H1 results for the financial year 2026 from JANA Small Finance Bank, or JSFB. And we've also looked at recent brokerage notes and, of course, the market technicals. The core mission today is to really understand how management is trading that short-term, high-yield, unsecured growth for, well, for long-term stability and a structural re-rating.
Exactly. And our goal for you, the listener, is to not just read the headlines, but to really get the strategic implications of the numbers. We'll cover the headline growth, then we'll dive deep into what I think is the genius of their de-risking strategy. It involves these federal guarantee programs. And finally, we'll ask why, despite all this fundamental strength, the stock chart seems to be, well, telling a story of caution.
Yeah, that's the big disconnect. So let's start with those foundational milestones for Q2 and H1 FY26. The bank has officially crossed the Rs 30,000 crore mark for both total deposits and its gross loan portfolio, or GLP. Deposits are now at, Rs 32,532 crore, and total advances are right there with it at Rs 31,655 crore.
And hitting that 30,000 crore mark, that really signals a new level of scale, right? That's essential context. But what about the quality of the expansion itself?
The growth rates, they really confirm the aggressive pace. So deposit growth was up 31% year on year, and a very strong 10.6% just in the last quarter. And critically, despite this rapid expansion, the asset quality is holding up. Gross non-performing assets, the GNPA, is at 2.8%, and net NPA is impressively low at 0.9%.
And the capital cushion looks solid too, I imagine.
Very much so. Their capital adequacy ratio, CRAR, that stands at 20.7%. So these numbers immediately tell you, okay, the bank is well capitalized to sustain this pace of growth, and it has sufficient buffers for any, unexpected shocks.
Okay, let's unpack this. Before we get into the loans, let's look at the funding side. The deposits, growth is great, of course, but bank stability is really built on reliable funding. So how solid is that deposit base underpinning this whole thing?
Well, what's fascinating here is how the bank isn't just getting bigger, it's getting better deposits. Yes, the overall deposit growth, 31.2% year on year, is fantastic. And while the ratio of CASA, the current and savings account balances may have dipped a little, the sheer volume of those low-cost sticky funds still grew by nearly 20% year on year.
I see. So they are actively attracting new sticky customers, even if the total deposit pool is growing faster because of, say, high-rate term deposits.
Exactly. And they're managing the cost of that funding really well. The cost of deposits actually went down by about 10 basis points in Q2, landing at 7.88%. But here's the key measure of stability for me: duration. Over half, 51% of their bulk deposits are non-callable. That means they can't be prematurely withdrawn.
That's a huge commitment from their corporate and institutional depositors. A real vote of confidence.
It is. And for the retail side, it's even better. 91.7% of all retail deposits are contracted for a duration of 1 year or more. When you have funding locked in for that long, you can plan your lending with so much more certainty. It insulates you from that short-term interest rate volatility. It's a massive operational safety net.
And speaking of safety nets, how does that translate into the overall balance sheet health? The liquidity ratios must be key here.
Absolutely. Their liquidity coverage ratio, the LCR, stands at a really robust 170% as of September. To put that into perspective for you, that means for every rupee they might theoretically need in immediate liquidity, they actually hold 1.70 rupees. That's a significant safety buffer against any short-term market stress.
Yeah, that's a classic sign of a conservative, really well-run treasury.
And it connects directly to their improving credit to deposit, or CD ratio. It's moved sharply from 100.2% a year ago down to 91.4%. And the lower that ratio is, the less dependent the bank is on external, potentially volatile funding. Deposits are just growing faster than loans right now, which is a powerful trend. Plus, they're using clever tools like the ASBA feature, which is traditionally for IPOs, to lock in and attract those crucial CASA balances.
Okay, so given how rock solid that deposit base looks, they must feel incredibly confident remodeling the other side of the balance sheet, the assets. Which brings us to the core strategic pivot. I mean, the headline for anyone watching this bank is this conscious, calculated shift away from unsecured risk. What are they doing specifically to secure their future, and where does that portfolio stand right now?
This is truly the most crucial strategic takeaway from all the source material. The bank is executing a comprehensive de-risking strategy. It's a real structural change. So secured assets, we're talking loans backed by property, gold, vehicles, they now account for 72.5% of the total gross loan portfolio. And that is up almost 8 percentage points from 64.6% just a year earlier.
Wow. That is an incredibly fast portfolio transition for any financial institution. But they have an even more aggressive long-term goal for this, right?
They do. Their target is, it's bold and highly ambitious. They aim to have approximately 95% of the entire portfolio either strictly secured or covered under a federal guarantee program by March 2027. So the breakdown is 80% strictly secured and about 15% unsecured but covered under a guarantee.
Okay, but wait. Shifting that fast means you're losing out on those high-yield unsecured loans, which, banks often use to boost their immediate profits. Is management signaling they think that segment is just becoming permanently too risky, or is this more of a regulatory preparation play?
It's a bit of both, I think, but mostly a choice for predictability over that short-term yield volatility.
Yeah.
They are deliberately sacrificing the highest margin assets, your microfinance, your pure unsecured loans, to dramatically lower the risk of a systemic credit shock. And they're achieving that 95% coverage largely through these, I think, brilliant federal guarantee schemes like CGTMSE and CGFMU.
Okay, explain those programs, because that's really the innovative part of this whole strategy.
Yeah.
How much of the risk is already covered today?
So these are basically government-backed credit insurance schemes. Think of it like a federal guarantee against default, particularly for smaller loans or microenterprises. And as of September 2025, nearly half, 49% of their entire unsecured and microfinance book, which is about 8,715 crore, is already covered under these guarantees.
So if you combine the secured loans with these guaranteed unsecured loans, where does that put them right now today?
They are essentially already at 90% coverage.
Yeah, it's a massive firewall against any high-stress scenarios in that MFI segment. They are, in effect, buying credit insurance for their riskiest assets to ensure their credit costs stay low no matter what the cycle does.
That seems like a really smart way to manage the inherent volatility in microfinance. But these guarantee programs, they can't be free, right? What's the concrete financial benefit if they're paying premiums for this?
Well, if we connect this to the bigger picture, the strategy is explicitly expected to generate a net profit. It should lead to a significant reduction in credit costs over the coming years. They are paying a premium, yes, but they fully anticipate collecting more in claims than they actually pay out. Can you quantify that? What's the projected financial benefit for the listener?
Certainly. For the financial year 2026-2027, they project paying around, say, Rs 80 to 90 crore in guarantee premiums, but crucially, they expect to get back Rs 120 to 140 crore as claim receivables from those same programs. So that's a net benefit of Rs 30 to 50 crore just for guaranteeing their loans.
So, they're paying a small insurance fee today to guarantee P&L protection and actually improve their P&L in the process. That is a true strategic shift. It's really focusing on capital security first.
And the expected return impact is also very clear. Their return on assets, or ROA, is projected to improve by 50 to 70 basis points once those claim recoveries really start to be realized.
Okay, speaking of credit costs, the bank created Rs 222 crore in accelerated provisioning in H1. Now that sounds like a large amount. Is that a sign of trouble, or is it related to this conservative de-risking stance you're talking about?
No, it's a sign of management deliberately taking a conservative, proactive stance. It's what we call future-proofing. They are accelerating provisions now to strengthen the balance sheet during this big structural transition. For example, get this, Rs 40 crore of that excess provision was created specifically on just Rs 60 crore of NPAs from that government-guaranteed CGFM UCG GTMSE pool.
So they're provisioning heavily even on loans that are government guaranteed. That just shows how hard they're working to keep that net NPA comfortably below that 1% mark.
It's a highly conservative approach. It's all designed to ensure stability and demonstrate control over their rapidly growing book.
Okay, so we've covered the de-risking. But if they're shifting away from unsecured assets, they still need massive growth somewhere else to hit those Rs 30,000 crore milestones. Which specific product lines are driving this rapid asset accumulation?
Well, the growth engines are centered entirely around high-momentum secured lending and these rapid dispersal products. Secured growth overall was 34% year-on-year and 8% just in the last quarter. They are basically swapping that slow, risky MFI growth for fast, secured growth.
Give us the numbers on the fast movers. What's really popping?
Gold loans saw massive momentum, up 17.5% quarter-on-quarter, which translates to a staggering 204.5% growth year-on-year. Yeah, that's a high-velocity, short-duration secured product. MSME loans, backed by property or equipment, also very strong, up 12.8% sequentially, so they're on track for over 20% annualized growth. And two-wheeler loans, another secured asset, surged 12.8% quarter on quarter, nearly doubling year on year with 97.3% growth. And affordable housing continues its steady climb at about 7.1% quarter on quarter.
So secured lending is heating up massively. It sounds like the high-risk, high-reward unsecured portfolio is really taking a backseat, which just confirms that strategic pivot.
Precisely. Unsecured assets saw a 7% degrowth year on year. That's a conscious shrinking of that book. And while the MFI book grew a little bit in Q2, its overall growth was 12% below their plan. That translated to about 60 crore in lower revenues for H1. Management is signaling loud and clear security over immediate high-risk revenue.
And how is the bank ensuring customer stickiness, loyalty beyond just the loan product itself? I saw they mentioned a strategy called Home 360, which sounds like becoming an anchor bank.
That's their play to maximize the number of products each customer holds. It's a classic cross-selling strategy. They use a core product, like a home loan, as the anchor, and then they bundle these highly attractive benefits. For example, they offer linked gold loans with zero processing fees and a 30-minute dispersal. They also offer pre-approved business loans up to Rs 5 lakhs and linked savings and current accounts with really attractive interest rates up to 7.5%. The whole goal is to just sell more into that sticky customer base.
That whole ecosystem, it sounds heavily reliant on technology. Are they keeping up with the digital infrastructure needed for that kind of integration and speed?
Oh, they are leading with digital adoption.
Yeah.
98% of all their banking transactions are digital, and 99% of their loans are digitally processed, which is key for speed and for scale.
Yeah.
Mobile banking registrations grew 110% year on year, so customers are clearly buying in. They're also innovating with new products like Credit Line on UPI, ensuring they stay relevant in that fast-moving digital payment space.
Okay, let's move beyond the quarterly numbers and talk about the big structural aspiration. The universal bank application. This isn't just about growth. It's about fundamentally changing who they are as an institution. What's the status there?
This is the potential re-rating catalyst the market is really waiting for. The bank formally applied to the Reserve Bank of India, the RBI, back in June 2025. It's for a voluntary transition from a small finance bank, or SFB, to a full universal bank. They're citing their strong retail and MSME franchise, their robust deposit base, and their governance track record as justification.
Right. And what does that universal bank designation actually unlock for them? Strategically and, in terms of valuation.
A universal bank status fundamentally changes two things: perception and opportunity. It potentially removes the regulatory restrictions placed on SFBs, so it gives them greater freedom in expansion and product lines. And more importantly, the market typically assigns higher valuation multiples, a higher PE ratio to universal banks because they're seen as more stable, less risky, and just having greater scale and permanence. It's a huge psychological hurdle to cross.
And they're also streamlining their internal structure in anticipation of this shift, aren't they?
Yes, they are actively simplifying. They're moving to merge the non-operative financial holding company into the core investment company, JANA Capital. This move gets rid of that mandated three-tier structure from the original SFB licensing norms. It just streamlines the organization for a potential universal bank setup and makes their structure cleaner for investors to analyze.
This all sounds overwhelmingly positive: structural change, growth, de-risking. But this raises an important question. What are the immediate risks? The challenges the market is watching that might temper this excitement and keep investors cautious.
Execution. Especially on near-term profitability, that remains the key risk. While H1 profit after tax, or PT, was healthy at Rs 177 crore, Q2 saw a sequential dip. PT was at Rs 55 crore compared to Rs 1 and 2 crore in Q1. And this dip was driven primarily by higher flow rates in the unsecured book and higher provisions, about Rs 27 crore more than they anticipated.
So the remnants of that riskier book are still causing some P&L volatility.
Exactly. And there was also a net interest margin, or NIM, compression of about 30 basis points in H1. And NIM is crucial because it measures the core profitability of lending. The market really wants to see that stabilize above 7%. Brokerage coverage highlights that while the growth and de-risking are positives, consistently stabilizing NIM and maintaining gross NPA below 3% are the key watch points.
So the fundamentals show this clear strategic de-risking and solid balance sheet growth, which should signal strength. But what does the technical analysis, the stock chart, tell us about investor confidence right now? Is the market actually buying this story?
And this is that crucial contrast. This is where the skepticism lies. Despite all the positive news flow, the technical analysis confirms the stock is locked in a medium-term downtrend on the daily time frame. Price has been consistently making lower highs and lower lows since May-June.
So why is the stock making lower lows if the bank is structurally improving?
Because the market is forward-looking and it's skeptical about the near-term impact of that NIM compression and the Q2 profit volatility, the technicals reflect investor psychology just waiting for confirmation. Both the 50-day and the 200-day moving averages are sloping downward, and they repeatedly reject rallies. They're acting as clear, dynamic resistance. These are psychological battle lines that the price just cannot seem to breach.
So until the price can convincingly break above those resistance levels, the technical trend really confirms that investor caution we see in the fundamentals.
And that caution is confirmed by the volume. Volume spikes are infrequent, and they mostly coincide with down days or failed breakout attempts. This suggests there's stronger selling pressure or distribution than sustained buying accumulation. So for a positional investor, the setup just remains unfavorable until the bank provides that undeniable proof-like stabilizing NM, or until the big structural catalyst that universal bank approval materializes.
So what does this all mean for you, the listener? We have a bank that's achieving significant balance sheet growth, proactively shedding unsecured risk through a clever, even profitable guarantee strategy, and aiming for this monumental structural transformation into a universal bank.
Oh.
Yet, the street is cautious. It's because of near-term profit volatility and a persistent technical downtrend.
And management's guidance for the full financial year 2026 is clear. They project about 20% growth in GLP and deposits, and they're aiming for expected return on assets between 1.1% and 1.5%. They are laser-focused on building a sustainable, predictable franchise by aggressively increasing that secured business proportion and emphasizing digital growth and governance. They're playing the long game.
And here's where it gets really interesting for me. The strategic move to secure 95% of the portfolio is bold, no doubt. But achieving the target of reducing net NPA to below 1% while expanding so aggressively in these high-velocity product lines like two-wheelers and gold loans, that will be the ultimate test. It requires flawless execution on both credit underwriting and digital scaling. We know the transition to a universal bank is the major structural trigger the market is waiting for. So given the strong internal governance track record cited by management, what factor, the ability to stabilize net interest margins above 7%, or the swift approval of the universal bank license, will ultimately prove to be the stronger driver in overcoming the current technical market resistance? Something for you to ponder as you review the results.